In the high-stakes world of hedge funds, where billions shift with a whisper, few stories are as cautionary or dramatic as the sudden downfall of Crawford Lake Capital Management. With over $1.1 billion in assets under management at its peak, this once celebrated New Jersey-based hedge fund fell into disarray in 2023, shocking investors and igniting debates across Wall Street. But how does a fund of this size, with institutional support and proven strategies, implode so quickly? Was it the market? Was it leverage? Or did the internal cracks run deeper than anyone realized? Crawford Lake Capital, founded by Isaac Markowitz and Jacob Herska, specialized in long/short equity strategies. These strategies, which involve betting on certain stocks to rise while shorting others expected to fall, are often seen as a balanced way to capture market opportunities while hedging against volatility. At a glance, Crawford Lake's approach made sense. Prudent, tested, and with performance that had attracted a loyal base of high-net-worth individuals, family offices, and institutional clients. But hedge funds are rarely what they appear from the outside. The story begins in 2020 when markets were in turmoil from the COVID-19 pandemic. Crawford Lake, like many hedge funds, capitalized on the extreme volatility, making aggressive plays in tech, biotech, and cyclical sectors. As stocks swung wildly, their positions paid off. Investors took notice. By 2021, assets had surged past the billion-dollar mark. The fund was outperforming benchmarks. The partners became known for their sharp instincts and market timing. But as the fund grew, so did the risks, especially hidden ones. By 2022, Crawford Lake began taking on larger, more concentrated bets. With the Fed beginning to hike rates aggressively and inflation spiraling, markets began to shift. Many hedge funds rebalanced, cutting risk and unwinding leverage. Crawford Lake, however, doubled down. Sources close to the firm reported that some positions made up more than 15% of the portfolio, well above the norm for a diversified long-short fund. And while returns were still positive, the underlying volatility in their positions began to unsettle some of their larger investors. Then came 2023, a string of misfires in key positions, particularly in overvalued tech names and biotech firms facing regulatory scrutiny, began to hit the portfolio hard. Meanwhile, the shorts, which were supposed to act as protection, also failed. Market momentum drove many shorted stocks higher, squeezing Crawford Lake on both ends. Performance cratered. By the second quarter of 2023, redemptions began flowing in. Investors wanted out, but the fund was illiquid. Many positions were thinly traded or deeply underwater. Selling would mean realizing steep losses, further eroding NAV. This is when the house of cards truly began to fall. As more investors requested redemptions, Crawford Lake was forced to sell what they could, usually their highest quality, most liquid names. This classic mistake, often referred to as selling the winners and holding the losers, compounded losses. It's a death spiral that even veteran funds have failed to escape. With the balance sheet deteriorating, the partners had to consider a full liquidation. In September 2023, Crawford Lake Capital formally announced it would wind down operations. $1.1 billion gone. Years of strategy, analysis, and investor trust erased. But this wasn't just a story of poor bets. It was a lesson in risk management. Reports from inside the firm suggest that risk controls were outdated, scenario models were ignored, and warnings from junior analysts about position exposure were dismissed. In fact, a former employee who spoke under anonymity said, "There was this belief that we were smarter than the market, that we had a read on things no one else did. But markets don't care about ego." It's a statement that echoes loudly through every failed hedge fund story. What makes the Crawford Lake collapse so relevant today is how it reflects broader issues in the hedge fund industry. In an era dominated by passive investing, ETFs, and algorithmic models, traditional long-short equity funds are struggling to prove their value. Fees remain high, returns are inconsistent, and the pressure to chase alpha often leads to overreach. As AI-powered funds, quant firms, and family offices gain dominance, many mid-sized hedge funds like Crawford Lake are being squeezed out. Not just by competition, but by their own outdated frameworks. The aftermath of the collapse has been wide-ranging. Multiple lawsuits are rumored to be in the works. Investors are demanding transparency. Regulators are beginning to scrutinize reporting structures and risk disclosures in similarly structured funds. Meanwhile, some of Crawford Lake's former clients have shifted capital to larger, more diversified platforms like Millennium Management and Citadel, where risk controls are automated and redemption windows are better managed. For aspiring hedge fund managers and investors alike, the Crawford Lake story is a masterclass in what not to do. Never become overconfident, never let concentration overwhelm diversification, and never ever ignore liquidity risk. Because when markets turn, the exit doors always shrink faster than expected. Crawford Lake Capital may now be a footnote in the financial history books, but its collapse offers enduring lessons. In the elite world of hedge funds, success is fleeting, trust is everything, and the margin for error is razor thin. As hedge funds face increasing pressure in 2025, from rising interest rates, geopolitical tensions, and unpredictable tech valuations, the downfall of this once prominent fund should serve as a warning to all. Adapt, diversify, and respect the market, or risk becoming the next casualty.